Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Welcome to Aviation Intelligence Weekly. I'm Sarah, and this is our deep dive earnings analysis. Today, we're dissecting United Airlines Q1 2026 10Q filing, released April 22nd. With me is Mike, our industry analyst. Mike, let's cut straight to the core thesis.
If we reduce this filing to one sentence, it's this. United is operating at peak capacity expansion margins, while simultaneously facing a perfect storm of external cost pressures that could compress profitability faster than management can adjust. Based on this filing, United Airlines is operating in late cycle peak territory. Strong demand metrics masking underlying cost inflation that's accelerating beyond their control.
That's a sharp take. Let's test that against the material changes from their last filing. What jumped out at you in the year-over-year comparisons?
The numbers tell a clear story of growth at increasing cost. Revenue hit $19.81 billion with operating income of $997 million. That's roughly a 5% operating margin, which sits at the lower end of what we'd expect from a legacy carrier in a strong demand environment. Passenger revenue increased $1.3 billion, or 11% year over year, driven by what management called a 3.4% increase in capacity, a 4.2% increase in yield, and a 4.1% increase in the number of passengers flown.
So they're filling more seats at higher prices. That sounds positive.
On the surface, yes. But here's the causality chain that concerns me. If fuel costs continue rising due to Middle East tensions, which management explicitly flagged, and if their 5.9% headcount growth continues at current pay rate increases, their cost base is growing faster than their revenue base can sustain. The filing shows aircraft fuel expense increased $339 million, or 12.6%, while salaries jumped $406 million, or 9.8%. That's $745 million in just two cost categories, growing faster than their $1.3 billion revenue increase.
Walk me through what management is actually saying about these pressures.
Management's tone in the MD&A is notably cautious, despite the strong top-line numbers. They specifically stated that geopolitical tensions in the Middle East caused disruption of flying in the region and contributed to materially higher global fuel prices that could continue in the future. The key phrase there is could continue in the future. They're not treating this as a temporary spike.
What actions are they taking?
They said they took immediate and decisive actions to mitigate the impact of the operational disruptions and rising fuel costs, including reducing lower margin capacity and adjusting fares and fees. This is classic late cycle behavior. They're already having to make tactical capacity cuts and push through price increases to maintain margins. That's not the language of a company with pricing power cushion.
Let's dig into the financial health indicators. Any red flags on the balance sheet side?
From a liquidity standpoint, they look solid on paper. $14.2 billion in unrestricted cash and short-term investments, up from $12.2 billion at year-end 2025. But context matters here. They have $31 billion in total debt, finance lease, operating lease, and other financial liabilities, with $3 billion coming due in the next 12 months. For a legacy carrier, that's a manageable but not comfortable debt load.
How does that debt service look against their cash generation?
Here's where it gets interesting. They generated strong operating cash flow this quarter, but they also spent heavily on financing activities. The filing shows they issued $2.158 billion in new debt, including $1 billion in 5.375% senior notes due 2031 and $1 billion in 4.875% senior notes due 2029, while making $1 billion in debt payments, including a $2 billion prepayment. That's aggressive balance sheet management, but it also shows they're constantly refinancing. If credit markets tighten or their operating performance deteriorates, this refinancing treadmill becomes problematic.
What about the risk disclosure section? Any new concerns flagged by management?
The filing notes no new or significantly escalated risk factors versus prior filings, but the three key risks they're monitoring are telling. First, the Middle East geopolitical conflicts affecting fuel prices. Second, regulatory actions or court decisions that would force us to limit our planned capacity at our hub locations in ways that are not aligned with our business strategy. Third, government funding constraints affecting airport operations.
That second risk sounds like it could derail their growth strategy entirely.
Exactly. United's business model depends on hub dominance, and if regulators start restricting their capacity expansion at key hubs, their entire competitive moat gets challenged. The fact that management is calling this out specifically suggests it's not just theoretical. There are likely ongoing regulatory discussions that could impact their operations.
Let's talk about their liquidity position in more detail. How stressed is this balance sheet?
Looking at the capital structure, they're walking a tightrope. Yes, they have $14.2 billion in liquidity, but they also have massive capital commitments. The filing shows firm aircraft purchase commitments with Boeing and Airbus scheduled through 2034. They don't specify the total dollar amount, but for a carrier this size, we're talking billions in future obligations.
And they're funding this how?
The filing states they expect to meet our long-term liquidity needs with our anticipated access to the capital markets and projected cash from operations. That word anticipated is doing a lot of work there. They're essentially betting on continued access to debt markets and sustained cash generation. If either assumption breaks, say if credit spreads widen or operating cash flow declines due to margin compression, they could face a liquidity squeeze.
What about their segment performance? Any winners or losers in the geographic breakdown?
The filing provides limited segment detail, but what's notable is their emphasis on other operating revenue, which increased $97 million, or 10.5%. Management specifically attributed this to an increase in mileage revenue from non-airline partners, including credit card spending with our co-branded credit card partner, JP Morgan Chase Bank. This ancillary revenue stream is becoming increasingly important for legacy carriers. It's higher margin business that helps offset commodity airline economics.
Is that sustainable?
From a unit economics perspective, credit card partnerships have been a bright spot for legacy carriers, but they're also dependent on consumer spending patterns and the partner's strategic priorities. If JP Morgan decides to reduce their partnership terms, or if consumer credit card spending declines, that revenue stream becomes vulnerable.
So, what should traders and investors be monitoring going forward? What would prove your late cycle peak thesis wrong?
Here's what to watch. First, fuel cost trends. If Middle East tensions ease and fuel prices stabilize below current levels, that removes a major cost pressure. Second, their capacity discipline. Management needs to prove they can maintain yield growth while controlling capacity expansion. Third, their ability to pass through cost increases via fare adjustments without demand destruction.
And the counter thesis?
If load factors hold above their current levels through Q3 while unit costs decline, meaning they successfully absorb the fuel and labor cost increases through operational efficiency, our late cycle peak thesis is wrong. Specifically, if they can maintain operating margins above 6% while continuing capacity expansion, that would suggest they have more pricing power and operational flexibility than the current data indicates.
How should we think about valuation here?
At current margins and with this cost structure trajectory, this equity trades like a mid-cycle expansion story, not a late cycle peak performer. The market seems to be pricing in continued margin expansion, but the filing suggests margin compression is more likely given the external cost pressures and management's own cautious language about future fuel costs and regulatory constraints.
Final thoughts on that core thesis?
After analyzing the full weight of evidence from revenue growth, cost inflation, management commentary, and balance sheet positioning, I'm more convinced of the late cycle peak thesis. United is generating strong absolute numbers, but the underlying trends, accelerating cost growth, external pressure on fuel prices, regulatory uncertainty, and aggressive refinancing needs, suggests they're operating at maximum efficiency with limited buffer for external shocks. The next 2 quarters will be critical for determining whether they can maintain this performance or if margin compression becomes inevitable.
That's our analysis of United Airlines Q1 2026 10Q filing. Remember, this is for informational purposes only and not investment advice. I'm Sarah with Mike, and we'll see you next week on Aviation Intelligence Weekly.